To Forecast Capital Management Q4 2022 market update call. I am Michael. I'm a certified financial planner and the junior advisor on our team. For those of you that don't know who I am, I'm head of the financial planning division, which creates financial plans and looks at life insurance reviews. As a reminder, please go ahead and mute yourself along with disabling your video until the presentation is complete. If you have any questions during the presentation, in the lower left-hand corner, there's a chat box. Feel free to put everything in there and we'll answer as many questions as we can, in the allotted time. We're trying to keep this one here to an hour. Now, before I start the call, I do want to update everybody on a couple new developments. You probably have noticed that we've sent more frequent emails from Forecast. These emails will continue and we'll do our best to provide relevant, timely topics that are beneficial for everyone. Some will be in written, some will be video based, but all of them will be helpful. And at any time, feel free to reach out to us to discuss anything related to these emails or provide any feedback. Additionally, we have partnered with another software company called Pontera. This new software allows us to manage any outside accounts that you might not be able to transfer as of now. Those include, but aren't limited to 401ks, 403bs, HSAs, 529 plans, and so forth. We have noticed that many employer-sponsored retirement accounts are down, 20% plus this year alone. And we now have the ability to help actively risk manage, those accounts and protect your hard-earned capital. Pontera now allows us to implement our global macro strategy within these accounts to manage them more effectively. If you have any questions or like to learn more about the software or get your accounts onboarded, feel free to reach out to any one of us and we're more than happy to help. So this call is going to be broken up into 3 different parts. First, John will take it on over. He's been in the industry for nearly 30 years. And previously to Forecast, he was the senior vice president at Morgan Stanley. He'll be discussing the risk that we are seeing in the markets, how accounts are currently allocated, and what to expect in the coming months. Next, Jason will take the realm. He began his career as one of the youngest independent future traders at the Jones Futures Pit. After his trading career, he graduated law school and received his JD, and he's the founder of Forecast Capital Management. You will be going over, a number of slides filled with the data that is really the basis for our investment decisions. And then, of course, lastly, we will be taking Q&A. But before we start, I am going to share my screen, and we're going to go over a quick disclaimer that states that almost all this slide and data is actually from our partnering firm, Hedgeye. So, Jason, John, can you guys see that? Okay, perfect. So go ahead and read this here real quickly, and then we'll go ahead and get started. And where we want to start here is, I want to just go over high level, since we have a lot of new clients and some prospects on this call. This is what we call as our quad map. And what this is showing is that we measure and map the rate of change of growth, or GDP, and inflation. As you can see, we are in the lower left-hand quadrant for potentially the foreseeable couple quads. And what that's showing you is that growth and inflation are both decreasing simultaneously. And what we call that is a quad 4. So when Jason, John, or I mentioned so with that, I'm going to stop sharing and I'll pass it over to John.
All right, let's get this thing rolling. Couple things. There's a decent amount of you on this call. A lot of folks watch this after they get home from work, so I just want to let you know that we're going to tape it and send it out to everybody. So I'm going to start like I typically start. I'm going to go through where we've been since our July 10th call. So I'm going to go through the past 3 months, where I'm going to look at today. Where are we at today? What are we seeing? How are we positioned? And then I'm going to look forward and say, all right, here's what we think could happen, and here's how we plan on getting positioned for it. Here, but then again, the opportunities this environment's going to create, we think, are going to be astronomical. We just got to get through this bear market. So having said that, and before I truly start, number one, I want to thank all of our new households that we brought on since July. I think we brought in about 20, 25 households, right, Michael? So we've had a huge amount of growth, and we take that very seriously. We're very humbled by it, and we value your wealth, and preserving it and growing it, sensibly, very important. That's a big thing of us. Risk manage that wealth, don't lose it, and grow it on a risk-adjusted basis. Also, as an aside, with all this growth that we're experiencing, don't be surprised if we add a couple of people to our team. We're actually talking to 2 different people this week. So by first quarter next year, don't be surprised if we've added, some employees. Michael coming on board when he did has been very helpful to managing that growth. We also need to get registered with the SEC. That won't impact any of you. It's just internally. We've already hired a consultant to do that for us. Once you attain a certain level of assets under management, you have to be registered with the SEC. And basically, that's what we're doing right now. All right. Also, the highlight of this quarter, at least for me, was the trip Michael and I took on September 13th. He and I flew out to Los Angeles and attended the first ever client conference that Hedgeye put on, a regional conference. So we flew out there, got to meet Pete McCullough, the CEO of the company, and some of his top analysts. To say that we were impressed would be an understatement. These guys are really, really good. Not only were we impressed by these guys, we learned a lot. I thought I wasn't going to learn much, and I was doing this for Michael. And in reality, I think I learned more than I thought I ever could, being an old man. A couple of things about that conference were really special. It was September 13th. That's when the CPI number came out. Hedgeye was the only one on the street calling for a hawkish or a hot CPI number. Wall Street was expecting something in the 7% range. Hedgeye was at 8.3. The number came in at 8.26. So here we are at a conference with about another 100 investors like us, or RIAs. And number comes out. We're right. The Wall Street's wrong. Market crashes 4.3%, and we were up that day 0.7. So it's really rare in this business that you outperform the markets by 5% in one day. And guess what? We happen to be at Hedgeye conference, ironically, with the guys that helped us achieve that. So that was kind of cool. By the way, we think that's the start of the second phase of this bear market. First phase was the easy phase. That was the inflation phase. This next phase that we're working through now is when the markets realize, guess what? We're in a serious recession. And, so we're entering the brutal phase of this bear market. As really it started when we were in Los Angeles. Couple more things was interesting. CEO of firm, Hedgeye firm, Pete McCullough, had 3 armed guards there with guns. So this fellow and his group of 80 employees are out to change Wall Street. They're tired of the fraud. They're tired of the corruption. They're tired of the little guys getting taken out. They're tired of CNBC, spewing misinformation. So they're calling these guys out. And as a result, they're trying to take out the CEO. So this is pretty serious stuff that's going on in these markets, guys. And we happen to be aligned with a firm that's making or trying to make huge changes that are drastically needed in the industry. Last thing on that is Jason and I are going to be they're doing a second, that one conference was so successful, they're having a second one November 10th in Dallas, and Jason and I are planning to attend that as well. So we'll let you know when we find out. All right, so having said all that, let's start with the numbers. a favorite part of this presentation for me. So since early July, when we had our last call, to today, the markets are down about 7%. We're up about 0.5% to 1%. So if you recall in the last call, we told you we think, we're done going down. We're positioned for a recession. The market's headed our way. Our losses should be from here on out fairly minuscule, and we just proved it, right? So July to now, -7, we're up 0.5. Even more interesting, the month of September was one of the worst months ever for the stock market. So the S&P in September was down 9.4%. The NASDAQ was down 10.4%. The TLT, or the long bonds, the US government long bonds, were down 10%. We were actually up 1.3% that month. So we outperformed the S&P by almost 11% just in September. So we're extremely proud of that. And we can tell you that doesn't happen with working 30 or 40-hour weeks, but it is what it is, and we do what we got to do. Year-to-date numbers through now, basically, we're down about 7 or 8%, plus or minus 1. Markets are down. S&P's down about 25%. The NASDAQ's down in the mid-30s, low to mid-30s, and so are bonds. Long-dated bonds are down, low 30s, believe it or not. And most of our competition, we consider ourselves a hedge fund. Most of our competition is down about 50% plus year to date. So hedge funds have been taken out on stretchers. This has been a brutal market to navigate. Where do we lose the 7-8%? Well, like we had told you in the prior call, a lot of it came in January when we pivoted from being very bullish to very bearish. That cost us about 4%. And then 3 different times this year, we've gone into bonds. Bonds, long bonds, US government bonds, historically in a deep quad 4, which we've got 4 in a row, which we haven't seen in 20 years. Historically, bonds do very well in that environment, except for this time. So we're going to try it again if the market dictates it. But these bonds in the US, interest rates better start coming down in the next 3-4 weeks or months, 3-4 months. Otherwise, we're headed for something called a funding crisis. And I'll explain that in a little bit. Actually, I'll explain it right now. A funding crisis is when the markets say, hey, you borrowed too much money as a country. We don't want to buy your bonds. We don't want anything to do with your currency. That is when the central bank loses all credibility. That is happening as we speak in Japan, in Europe, in England, especially. Right now, they're in the hot seat because their interest rates are going parabolic and their currency is crashing. So that is incredibly scary from a sovereign nation standpoint, because you're not going to be able to fund your country if the funding crisis continues to metastasize, So if our interest rates don't start coming down in the next 3-4 months, we may be entering that same predicament. Too early to tell, but it's on our radar. A couple more things. We brought in a lot of clients, and what we're shocked to see is that most of these clients are in 70-30, 60-40 allocations, where 70% of the money's in stocks, 40% or 30% in bonds, or 60% stocks, 40% bonds, or in these target dated funds that say, oh, I'm going to retire in 2030, so invest accordingly. Well, guys, that's not hedged, right? Wall Street's lazy. Wall Street is telling you by going 60-40, you're going to be hedged, because when your bonds go down, your stocks will go up, and vice versa. That's not happening. That's really never been the case. It's just a lazy way to tell you you're hedged, but you're not. We're hedged. We're short. We got a lot of cash, right? So for example, a 60-40 allocation is down 21% year to date. 21%, right? That's the worst since 1931, during the Great Depression. So we feel really bad, especially older clients that we're bringing on board, and we're watching what they're invested in. It's like, wow, these people, don't forget, there's that saying that says, don't fight the Fed. The Fed's telling you, if you're in stocks, bonds, real estate, crypto, we're going to destroy your net worth. That's what the Fed's telling you, right? They're raising rates. They're cutting their balance sheet, and they're telling you, we're going to fight inflation by creating a major recession and by destroying your wealth. We mentioned this in the last call. That's exactly what they're doing. So if you're in a 70-30 allocation, 60-40 allocation, you're fighting the Fed. Good luck, right? If you've got these, I mean, we brought in one guy Friday, right, Michael, who had that 20-30 allocation thing. Sorry, no, he had the 20-30 target dated fund as his investment because he's retiring in 2030, and he was down 7.5% just September. That's not a hedge. That's called a mess. Okay, so that's the last 3 months. That's where we've been. So needless to say, we held our own, and you know, we really had a really good quarter relative to the rest of the market. So what are we seeing now? We're seeing a market that's incredibly scary. The volatility indicators on both the NASDAQ, the S&P 500, and the Russell 1000 or 2000, they're all in what we call the uninvestable bucket, north of 30. Anytime the volatility indicators of these major markets goes north of 30, your crash risk goes up exponentially. That's why if you look at your accounts, you're about 70% cash for a reason, and you're short about 15%. This market is very dangerous. Not only are the major markets have a volatility indicators that are in the scary bucket, the bonds, something called the MOVE index, which measures the volatility in bonds, is as high as it's ever been, or pretty close to it. Obviously, crypto, if you're still in that nonsense, you know, that VIX is north of 60. The CDSs, which are credit default swaps that measure the risk in either companies or countries, they're going parabolic. So, for example, Credit Suisse in 2008 was at the forefront of the collapse, you know, the financial collapse. At that point, their CDS has got to about 2.25, 2.5. As of today, they're north of 3. So when we see things like that, we know that the pressure is rising beneath the surface. So this is not an environment where you want to be long. You don't want to be long stocks. You don't want to be long bonds. With the volatility indicators where they are, you're asking for trouble, and the risk of a true waterfall event or serious downside in one day goes up a lot. So what risks are we seeing? We have a Federal Reserve and most central banks tightening into a global recession. We have never really seen a synchronized global recession where most major countries are entering a recession at the same time with high inflation and with central banks raising interest rates and selling bonds. This has never happened before, guys. So if you want a freaking depression, this is what you do. So if the Fed doesn't backtrack soon, I don't know where this goes. China's entering a recession. First time since they entered the World Trade Organization. By the way, China got us out of the 2008 recession. They were able to print hundreds of billions. You know, they created the commodity bubble, so on and so forth. This time around, they're entering a recession. We're entering a recession. Europe is a basket case, you know, recession plus plus. Who the hell's going to bail us out? There's no large enough entity to bail us out of a worldwide recession when central bankers are encouraging it. Let's see. By the way, well, I don't even want to go there. Yeah, so these central banks are trying to fix a problem that they caused, i.e., inflation, by literally taking a sledgehammer to the economy, right? So they're literally trying to create a depression to make up for their mistake of creating inflation. So they're going to try to fix one problem that's bad or create an even bigger problem. And that's typically what they do. Other major risks that we see, the Fed may go too far in quantitative tightening. They're actually physically did start shrinking their balance sheet this month. I had my doubts, they're doing it. And they're raising rates, right? So they're going to probably go too far, and they probably already have, frankly. Emerging market currencies, developing market currencies, these things are behaving like ping pong balls. They're bouncing all over the place. Inflation is not going to go down nearly as fast as the Fed hopes. a year from today, we're probably going to still be looking at 4.5 to 5% inflation or more. Europe is in a major recession and an energy crisis. War is typically what happens when we hit an environment like this, where central banks and governments are trying to deflect the blame to someone else. They go to war. That's why you notice nobody's trying to stop this Ukrainian war. Why? Because they want to deflect attention away from their incompetence to something else. The negative wealth effect is a really big deal. We've already lost 12 trillion in market cap just in US stocks, 2 trillion in the crypto. Bonds have lost trillions. I don't have that number. Your housing market is just starting to turn. We wouldn't be surprised to see that thing drop 20% or more. Emerging markets, international markets, they're all in free fall. So the wealth destruction so far has been off the scales. I mentioned England, they have a funding crisis. Japan has a funding crisis, Europe, and God forbid we have one too. Another big bubble area is mega cap tech. So Apple, Microsoft, Tesla, Amazon, whatever. I mean, Apple still has a market cap over 2 trillion, right? And I've been told over and over again, oh, that's Apple, it never goes down, it's a great company. Well, let's go back to 2000. I remember it vividly. Cisco at the time, Cisco Systems, was the Apple of that era, right? So everybody's telling me, hey, Cisco's great, they're the internet, they created the internet, you gotta own it, blah, blah, blah. I remember selling out all my clients at $55 a share in February of that year, 2000. 3-4 weeks later, the thing's at 77. I looked like an idiot. I lost 2 clients. They did call me idiots. A year and a half later, that stock was down to 10. 85% decline. That was the Apple of the time. Guess what it's trading at today, by the way? $39 and change. So if you don't think Apple can get cut in half and get cut in half again, you don't understand markets. That's how they behave. Markets, so people, they're telling me, oh, you guys are so bearish, blah, blah, blah. And, this, although we've had a lot of declines, things look stable. And I tell them, yeah, that's what the side of a mountain looks like right before an avalanche. Or that's what, a sinkhole looks like, right? If you're driving around, everything's fine, all of a sudden, you got a sinkhole that's 30 feet deep. What the hell happened? Why didn't I see that? So I use the analogy of an avalanche a lot, right? So if you look at an avalanche, what happens is you're staring at the side of a mountain, everything looks nice, peaceful, nice fluffy snow, the sun's out, everything's great. And then 1 minute later, you're buried by a 30-foot avalanche, right? Well, right now, if you look at the side of the mountain, the market mountain, it all looks fine, kind of. The problem is underneath, everything's moving, everything's breaking, right? The last thing that breaks is the surface. Well, we're at that point where the surface is starting to cave in. That surface is Apple. That surface is Tesla. When those things go, that means the entire market's finally going to implode. We're almost there. I mean, Tesla's down 30% in the last month. So it's already starting to happen. Apple is starting to show signs that it's about to go into a free fall too. I forgot about that Cisco trade. We made a few 100% on that, by the way. So it was a pretty good trade. Okay. What's our current allocation? We're short about 15, 16%. We have about 10, 8, and actually we sold some. We have about 8 or 10% US dollar index, which is the best performing asset class year to date, up about 18%. Just buying US dollars, you made 18%. Why mess with the markets, right? We got about 65, 70% in treasury bills and cash, and then we got about 5% in just corn, wheat, stuff like that we're just trying to play for a trade. So effectively, we're designed for a crash. If this thing were to go down 10% tomorrow, we'd be up about 2%. Oh, and by the way, the World Bank thinks that there's a 69% chance of a depression in 2023. And they're actually pretty good in terms of doing that stuff. All right, strategy going forward. So in order to create wealth in this environment, the first thing you do is preserve capital, right? This bear market, if we're right on this crash, has got at least another 6 to 9 months to go for our data. We're only in the first quarter of quad 4 quarters. So we're, 3 to 6 months from now, this place is going to look real different, right? So the goal in managing money is in an environment like this, where you're in a bear market, markets are crashing, you're entering a very severe recession. First of all, protect capital, which we've done. If you're down 8%, it's a hell of a lot better than being down 35, right? We need to be up 8 to break even. If you're down 35, you need to be up 40-some% to break even. Then this thing will bottom at some point in 6 to 9 months is our guess right now. When it bottoms, a couple things will happen. Most people either have no money because they got blown up, or they're so damn scared of their own shadows that they're just going to stare at it because guess what? They chased they bought the dip so many times and lost money that they're not doing it again. Well, we'll be in a position to know what's a real bottom within 2 to 3 weeks of that bottom hitting, given our data and our process. So if you go back to October of 2020, when we had the call like this and we told everybody, you're going to get 2 to 3 years worth of returns in the next 2 to 3 months, give us all your cash now. Remember that call? Well, we ended up going up 41% in 4 months, right? Between November 1st of 2020 and February 28th of 2021. Well, the setup, we think that the setup we'll see at the bottom of this particular bear market / recession / crash potentially could be just as, almost as good as what we saw in 2020. So when everybody else is going to either be too scared to do anything until the market goes up 40-50%, which is what most investors do, or people that have been destroyed. We want to be there at the bottom, massively and aggressively investing. So if we're down, call it in 6 to 9 months, let's say we're down 4% because we're kind of chewing away at our losses, we can make that back in 1 or 2 days. Once you hit bottom, it typically goes straight up. It's a V-shaped recovery. So if we can get close to that bottom, man, is that going to be awesome. So as depressing as I sound, as scary as this environment is, the opportunities out of this are going to be phenomenal. One of the first things we'll start buying when we see things that are starting to, normalize is gold and bonds, assuming the data tell us to. But those are kind of going to be the two main things. Once we start buying that means that the market is definitely pricing a recession. And then hopefully we can start making money a little quicker because we can deploy a lot of that cash. We'll also cover our shorts. We'll also probably short the dollar, all that kind of stuff. Let's see. My guess is you'll never see another $1 trillion market cap when this is all said and done. I mean, this is nuts. I mean, it's so hard to understand $1 trillion, and yet we've got a half dozen stocks that are worth over $1 trillion. So what's the Fed's job? The Fed's job is not necessarily to protect you against the recession. It's to make sure the Treasury can borrow money at an acceptable rate. That's what they're there for. They're trying to keep the Treasury solvent. So for all of you, hoping and praying for a Fed pivot so that, we're back to the races, good luck. When the Fed finally does pivot, which they will, it's because everything's breaking, right? Because there's some really serious stuff going on. And you don't necessarily want to invest at that point. So be careful what you wish for. I'll end it on this note. Actually, 2 more things. There's $200 billion of hedge fund redemptions that are on their way at the end of this year. That's a lot of money. A lot of these hedge funds are done. So people are going to bail out, take their money and run. So you got about $200 billion of redemptions coming in the 4th quarter. That's not positive. That's kind of scary. That's a big number. You also have blackout periods right now. So corporations can't buy stock through the end of this month. You've got CTAs that are in sell mode. And you've got mutual funds that about a quarter of mutual funds have their year-end calendar, their calendar year-end is the end of this month. So they're going to be doing a lot of tax loss selling. Because the last thing they want to do is say you're down 20%. Oh, and by the way, you owe taxes. So they're going to be out there selling too. So October is going to be kind of interesting. I mean, there's a potential that this thing truly unwinds this month. Last thing, if you look at what's truly going on, it's basically a worldwide margin call. A margin call is when you borrow money, your portfolio drops below a certain amount. You know, TD calls you and say, hey, you need to bring 100,000 to the table or we're going to sell you out, right? That's what a margin call is you borrow money, you lose some of that borrowed money and the institution involved gets scared and calls you, right? Well, what we're experiencing is a worldwide margin call. You had central banks all around the world creating a mountain of debt, taking interest rates to zero, and goddamn, they went negative. There was 17 trillion of negative yielding interest rate instruments January 1st of this year. Now we're down to 2 trillion. How dumb is that, right? So these central bankers create the mother of all bubbles by creating the mother of all money printing, zero interest rate nightmare. Now we have this major inflation problem because of that, right? And so now what they're doing is they're coming in and raising rates faster than they ever have and decreasing their balance sheet as fast as they ever have after they created the mother of all bubbles in finance, in debt. So how this ends, a little bit like a mushroom cloud. Anyway, I digress. All right, Jason, I'm done scaring everybody. Your turn.
Nice work, John. That was awesome. Can you hear me okay? So
Yeah.
Michael's going to share our slides here. And what I'm going to do is I'm going to show you all the data to back up what John said. So I think it's important for everyone to understand that this isn't just a thematic view. This is a data view. It's not us guessing. So we work in probabilities. So what I want to do is put some color on it. So we're going to go to the US real GDP year over year. So we show an update to this slide each and every quarter to provide an understanding of where we've come from and really where we're going in GDP or growth terms. As you'll notice from the chart, we are beginning to see a deceleration in GDP terms on a year over year basis through the end of 2022 and into the first half of 23. And I might add that the Federal Reserve, as John had mentioned, is raising interest rates into this growth slowdown, which we will go over in more detail as we move through the slides. But raising rates into a growth slowdown has never had a good outcome, historically speaking. This is US headline CPI. We also show an update to this slide each and every quarter. What you'll notice is that CPI peaked in the second quarter of 22, and we're now beginning to decelerate in CPI terms. Now, what I want you to take away from this chart is that even though we're seeing CPI decelerate over on a year-over-year basis, we're still very elevated and will continue to remain elevated through the first half of 23. So CPI and GDP will continue to decelerate through the first half of 23, and thus the probabilities are high that we have 4 quad fours, as John had mentioned, in a row through the second quarter of 23. So this volatile market breakdown is not over as we continue to see negative data sets. FOBs. So this is an acronym for Federal Reserve Operation Break Stuff, or you could use the 4-letter word for stuff. The Federal Reserve, at the very least, understands that the rapid increase in interest rates is going to break a lot of things economically, not the least of which is the US stock market. The part of the economy that they must keep operational are the credit markets. And this tightening regime is unprecedented in the pace of change, in the rate of change, as you'll notice in 30-year fixed mortgage rates and the breakdown in the Treasury bond index. Those are pretty drastic, as you'll notice. The world relies on US dollar liquidity I'm not sure if everybody understands how much it relies on it, but they rely on it in US dollar liquidity in order to pay for dollar denominated debt, which has exploded in the last couple of decades. The world is basically entrenched in a short dollar position. So the world needs more dollars. When the world needs more US dollars to pay their US dollar denominated debt, there's a massive demand for US dollars and a liquidity squeeze. Currently, there's a global credit unwind. As such dollar denominated assets get sold in order to cover dollar denominated debt. So the cost of capital is going vertical, the value of the collateral is collapsing, and a surging US dollar is driving an epic dollar-based liquidity squeeze for the global economy with trillions in US dollar debt. The Fed's policies are affecting global currencies negatively. What the US has that many other countries don't are relatively better growth conditions, a higher neutral rate, and they are the beneficiary of dollar-based demand. The US actually can weaponize the US dollar doom loop, which I'll explain in the next slide what the doom loop is to its advantage. And due to the Fed's policies, the pound is the weakest it's ever been. The yuan is the weakest since 2008. The euro is the weakest since 2002. And the yen is the weakest since 98. So this is the doom loop that I talked about. And how it works is the US dollar goes up, the Fed tightens, so rates go up along with the US dollar, foreign currencies go down, and inflation goes up. Thus, global central banks are forced to tighten into a slowdown, which slows growth in those countries drastically. So the intervention paradox, which is on the left-hand side, is when the Federal Reserve sells US treasuries to support the US dollar, which increases US yields, and it strengthens the US dollar both in relative and absolute terms. Financial conditions are tightening at the fastest pace ever. The pace of tightening has eclipsed the pace of the tech bubble burst of 2000 and is sitting just south of the great financial crisis. Tightening may actually very well eclipse the pace of the great financial crisis. Rate-sensitive consumption is tanking. This year alone, existing home sales have collapsed since January, as you can see on the left-hand side. In fact, luxury home sales on a year-over-year basis are over 28%, as you can see on the right-hand side. If you believe the Federal Reserve, as John mentioned, is going to pivot on their policy and lower rates, I really hate to be the bearer of bad news, but that's not going to happen anytime soon. In fact, and here's where the data comes in, the January 2024 Fed funds futures have moved above the January 2023 Fed futures, indicating that the market has fully shifted to a higher probability that the Fed hikes into 2023 and thus no rate cuts in 2023. That's scary. So everybody that's waiting for that V-shaped recovery, Fed comes in like Superman, not happening anytime soon. This is really another slide based on data. So the Fed is not going to stop hiking in 2022, as we mentioned. But the fact is the market is pricing in another 5.11 rate hikes. I know it says 4.56, but we didn't update it. This is updated to the day. So the market's pricing in another 5.11 rate hikes before the end of 22. And basically what that means, the Fed may hike over 125 basis points more prior to year end. So 25 basis points equals one rate hike. This is a global setup. John said this, it really is. It's not just occurring in the US. 85% of countries have two quad fours. And as our quad map showed, decelerating growth and inflation. And so 85% of the countries have two quad fours in the next 3 quarters. A quad four environment is when inflation and growth decelerate on a year-over-year basis. This is where bear markets and recessions occur. 83% of central banks are raising rates into a slowdown. And this is a very dangerous setup because it is global. As I mentioned before, the US dollar is very important for the global economy. For example, US dollar accounts for 96% of trade invoices in the Americas, 74% in Asia Pacific, 23% in Europe, and 79% in the rest of the world. Debt is becoming increasingly expensive, and the need for dollars is exploding. No matter where you are in the cycle, labor is a lagging indicator, and today it's no different. So as we move through this recession, one of the last indicators to crater is labor. The current NFP, or the non-farm payrolls gains, that have been recently released in the face of the recession is hardly an anomaly. In fact, this chart shows that many recessions begin with NFP gains, but shortly thereafter move aggressively to the downside. People are going to lose their jobs and lose their pensions in this disaster. This slide sheds some light on the current labor dynamics. So what you'll notice is that there is a significant loss in full-time employment on the left-hand side, but gains in part-time and multi-job holdings. So those individuals reporting both their primary and secondary jobs as full-time hit another all-time high in August. We can only postulate as to why, but we're pretty confident that many households are having difficulty overcoming the cost of living squeeze, thus are doing what they can to make ends meet. The prices for essential goods and services have continued to accelerate in August, and the cost of these goods and services are outpacing wage growth. So these price increases are taking a larger and larger portion of consumers' wallets. This slide is pretty simple to understand. We have had 17 consecutive months of negative real earnings growth. Inflation is really creating some serious issues for many Americans. As the government provided checks to Americans in 20 and 21, the savings rate increased. But now the savings rates have cratered, and those in the bottom income quintile not only retraced any pandemic-related gain, but it's now negative 43.8 billion less than pre-pandemic levels. The personal savings rate as a percentage of disposable income is at 13-year lows. So the question is, how in the world are Americans getting by? Credit cards. 233 million consumer credit accounts were opened in the second quarter of 2022, while deposits fell by a record 370 billion. 98% of all businesses in the United States are small businesses. Small business really is the lifeblood of the US economy. So small business sales and earnings have hit recessionary levels, and it may get much worse. I'm going to do my best to kind of explain this, but I think it's important to know where we are in this recessionary environment. The average rate hike cycle historically is 28 months. And this is data since World War II. Currently, we sit at 8 months, and that's counting from February 22 to September 22. So unfortunately, this rate hike cycle isn't over. And we already know that the average rate hike cycle since World War II is 28 months. But what's the magnitude of the policy response? In other words, what's the percentage change in the Fed funds rate? It's 6.5%, and we currently sit at 3%. So this is an interesting slide, and it provides more evidence as to why this rate hike cycle isn't over. This compares the change in the Fed funds rate versus the change in CPI, or the inflation standard. As you can see, we currently have a Fed funds rate that's less than 5.8% of CPI. The spread will close, but that will be due to an increase in the Fed funds rate and a decrease in CPI. Last slide that I wanted to put out there is used vehicle prices. This was a big part of inflation. We're now seeing used car prices fall at their fastest rate ever. They're down 12.9% from the January 22 highs. And that's all I have, Michael, for slides. And I know that people have questions, so I'll leave it to you to ask those questions.
Awesome. Appreciate all that, you guys. We did have one come on in here. So, sorry, I'm kind of on two different screens here. Let me move this over. There we go. So question in the chat box from Mike. John said, if we can get close to the bottom crystal ball, from a timing perspective, how close do you expect / hope to be? Exact day, within a week, month, quarter, early or late, or from a, percentage change. So I guess really, how are we going to tell when the bottom is getting priced in here, you guys?
I'll take this one, Jason. You can follow up. So there's going to be a few things going on, right? Number one, we're going to be looking at our data like we do for everything else. We know where to look to understand how close we are to a true bottom, right? So when can that happen? I mentioned earlier, we think there's at least 6 to 9 more months of this bear market to go. Could be shorter, could be longer. We really don't have to figure that out today, right? We'll have the data and we'll figure it out at the time as we get closer. In terms of more percentage declines, we're down 25% now. We could be down, I don't know, 40, 50% when this thing finally hits bottom. I mean, I had a new client late last year or in January asked me that same question. He asked, what are the scenarios? How bad can this be? And I gave him 3 scenarios. I said, one is your run-of-the-mill ordinary correction, down 10% plus or minus, and you're back in the game in 2 to 3 months and you're off to the races. A second one is your traditional bear market, which is what we're in so far, right? Where you're down 20 or 30%. It lasts about six to 9 months, and then you recover. That's your traditional bear market. Or we can have something more extreme and more in like what we had in the 1920s, 1929, 32, where the markets dropped 80%. What I told this particular individual, I said, that's technically what we should be seeing, because the extreme nature of today's economy is frankly worse than it was in the 20s, a lot worse. So, but the probability of us getting there, I don't think that's going to happen, but I wouldn't be surprised to see something between minus 25, 30 and minus 80, somewhere in there. Jason, anything else to add to that?
Yeah, it's tough to answer this because, he wants a definitive and it's tough for us to give a definitive. What I can tell you is that as soon as John had mentioned, as soon as our data changes positive, or, when we go through these quads and we probability weight where we're going in the next quarter and the quarter after that, it's not an exact science. So even though, in the second half of 23, we're seeing some light at the end of the tunnel, that doesn't mean that this market can't, bleed into the second half of 23. So it's hard to say. My expectation is that our quantitative signal is pretty good. It's probably one of the best quantitative signals that I've ever seen. So for us, we're probably going to be one of the quicker firms to turn. So I don't know what that time is, but it could be a week, it could be a month. I don't really know, but it's going to be pretty quick. The day that quantitative signal turns, and it turns on a dime. So.
And Mike, those are really good points, Jason. And Mike, one of the things that we struggle with or we have to manage, which is very difficult, is, for example, in 2000, between 2000 and 2002, the NASDAQ dropped, or 2003, the NASDAQ dropped something like 78%, right, 80%. But in that 2-year period, you had 7 rallies of over 20%. So when you guys see us doing, so we need to know which one of those rallies is real and which one's a head fake, right? And that's where what Jason was mentioning. Our data is really good at telling us this one's fake, this one's fake, this one's fake. It's over. Let's go. And when you see us trading your accounts, like right now, we covered a lot of shorts, right? If you notice, look at your accounts. You're not as short as you were, like you were last week, because we got the CPI number coming tomorrow or Thursday. So we're always having to go back and forth because we don't know when a rally is real or another head fake that we need to short. So that's where our data gives us the edge.
Perfect. So just as a reminder, you guys, lower left-hand corner, feel free, put in any questions you guys might have. We did have some that were emailed to us from other clients that couldn't make the call. So Jason, I think this is a good one for you here. It says, what is the difference between this bear market and others in the past?
We hit on a few of these, but I would say the most glaring difference is that we have the bubble of all bubbles popping is number one. Number two, we have more debt than ever by a long shot. Number three, we have a globally synchronized recession. Four, we have global central bank rate hiking into a recession while fighting some of the highest rates of inflation ever. That's the difference. Those are pretty big.
Absolutely. What about you here, John? Why is the USD so strong today or this year?
Oh, the US dollar? Yeah, the reason it's strong is what Jason and I talked about earlier. Jason, I think, mentioned a shortage of dollars. I mentioned the fact that if I'm Brazil and I want to borrow money to run my government, I need to borrow $100 million. I'm not going to be able to borrow that in reals. That's their currency because it's a shit currency. Nobody wants it. So I have to go borrow in dollars, right? So I borrow in dollars, and all of a sudden my real lost 20% against that dollar. So that $100 million debt that I had is really now effectively 120 million, right? So that's why the dollar is strong, because all these nations have raised money in US dollar terms, and now they're having to pay those back because they're getting destroyed. So they're having to quickly start paying it back, hence creating a demand for dollars. So as debt starts to shrink worldwide, the dollar goes higher because the demand goes higher. And plus, I'm in crypto. I'm down 80%. I'm going to take that last 20% I saved, and put it in dollars and just buy treasury bills, right? So as assets continue to collapse all around the world, you sell them and you go into dollars. That also makes the dollar stronger.
All right. What about this question here? So it says, what are the ways that the U.S. and the world economy can do to lessen or turn the economy back around? Jason, I think this is probably right up your alley here.
Oof. That's a great question that I'm not sure I have an exact answer for. I'll give you some insight into what I think, but the Federal Reserve and many central banks around the world have really painted themselves into a corner by printing massive amounts of money. So now we have this huge amount of debt. And as much as you hear that governments can inflate themselves out of debt, that's BS. They can't. So the fact is that you have unelected officials in the Federal Reserve claiming no responsibility for their terrible policies. They're the root cause of many of the issues we're going through, and we can't keep going in this direction. So first, something that needs to be done is rein in the power of the Federal Reserve. In my years in law school, and don't hold that against me, but I can confidently say that the founding fathers would not have agreed that an unelected official or even a private entity should have unlimited power. And it goes without saying that the Federal Reserve's gone beyond the regulatory authority. It truly has. The things that they have done go outside of their legal parameters. So unfortunately, because of these unelected officials, we're now in a place where certain areas of our economic system are going to break. Now, this isn't all bad because that gives us an opportunity to build a better system. but I do not believe there's a way to save an already broken system. And the government and the Federal Reserve really needs to be proactive, not reactive. They're operating in really on past data, and they're not paying attention to the incoming data. So we can be much better, but to get there are some things they're going to end up breaking, and it's going to be a tough one. But that would be a good start.
I like this one. So Alec just wrote in a message or a question here, and it's been fun, recently. So his says that he's wondering about leveraged ETFs, if that's going to be potentially a strategy of us moving forward from here. Just like SQQQ. So I know, John, we've been going back and forth and loving this so much. I'll let you answer that one.
Well, Alec, I love you, man. Yeah. So you saw me place a trade for SQQQ. That was the first time we've done that, because those products, UVWI, I think is the other one that I used. Those products are 3 times leveraged. So if you want to lose your entire net worth and you don't know what you're doing, use these things. So you got to use these very, very, very specifically and very carefully, right? We made a shitload of money in just a few days, right? I placed it in a bunch of clients. I think I went as high as 75 basis points, or less than 1% in each one of these things. These things go up 10, 12% a day, or it can go down that much, right? So yes, Alec, I know you love these kind of things with leverage. We will be using them, especially as this bear market really blows. We will be using that, but very, very cautiously, because they're really a good way to juice up your returns if you do it right. So I get excited with stuff like that. It's like, okay, I think, and the data once again tells us when, like when I placed that SQQ trade, the downside to upside, I think, was 18-1 on the S&P. That's why I did it, right? But you guys should never play with this kind of stuff, because you don't have that data, right? And what did I do? I covered it all, right? Yesterday, it's gone. Why? Because I have a CPI number coming out tomorrow. And if that number happens to be dovish, SQQQ could be down 10% in one day. So I'm not going to take that chance, or we're not going to take that chance.
Perfect. This one will also go back to you there, John. Jason, I know he's the gold bug compared to us too. So I'm going to mix two in together. So Tim asked here, how will gold hold up in these quad 4 periods? And we did get a writing question. So on top of that, should we be buying physical, precious metals as of today?
Okay, so Tim, obviously gold is not holding up very well, right? Gold is no different than any other asset class. And when you have a deleveraging going on in your system, gold and silver get hammered usually too. And the reason for that is gold is one of the more liquid markets in the world. So if I'm getting a margin call, remember I mentioned margin calls earlier? The way to free up cash to cover those margin calls, a lot of times is selling your gold. So gold doesn't do well in the beginning of a crash. Gold does not do well when interest rates are rising, which they are right now, right? Interest rates and gold. Interest rates are the most important component of gold's price behavior. And the dollar's been strong. So gold's down, I think 7-8% year to date. Silver's down a lot more than that. Silver is whatever. But gold, Tim, I think you're going to be able to buy it if you see us starting to buy bonds, we're going to buy gold, because that means that interest rates are done going up. Now, at some point, if this system continues to progress where we think it could go, and God forbid we enter a funding crisis in the United States where our bond interest rates just shoot up and the dollar goes into a free fall, yeah, you're gonna want to own physical gold. I think you're gonna want physical gold anyway. Don't get carried away with it. But the rule of thumb is 3 to 5% of your net worth in physical gold. It's an insurance. It's an insurance on everything else blowing up. So everybody should have a little bit, in my opinion. The The problem is people get carried away and they don't think, 3% is now 5%. If we're right and this funding crisis hits this country, 5% of gold is going to basically insure your entire net worth, because it's not going to stay at $1,600 an ounce. It'll go to 5, 10, 15, 20,000 an ounce, right? So that'll be enough to protect the vast majority of net worth. So yes, buy a little physical, and hopefully, and we'll be buying gold soon, but we got to wait for the data.
Perfect. I know we're coming up on time. Maybe one more question here, kind of to do with the Federal Reserve. So I'm going to kind of loop these two together. So first question is, what is keeping inflation running so hot for so long? Shouldn't it be coming down due to the increasing, rates? And then also, why is everybody focused on the Federal Reserve pivot that we hear day in and day out? So maybe Jason, you start, and then John, you finish up.
Okay. So inflation is, let's see, I'll start by saying the things that are keeping inflation running hot are housing, food, at home, agriculture, and energy. So the Fed really is behind on the rate hikes. So it's going to take time for rate hikes to catch up to inflation. Inflation may be coming down, but it's still at really high historical levels. And we don't see inflation coming down to fairly normal levels until the second half of 23. So hiking rates are not going to reduce prices in household essentials. It just isn't. It's going to eviscerate the middle and lower income households. That's the unfortunate aspect. It's not, when rate hikes occur, the effects of those rate hikes aren't seen for a year after those rate hikes, typically. So if people are thinking these rate hikes, or investors are thinking these rate hikes are going to bring down the costs of their everyday essentials, it doesn't happen that way. It's not that quick. These aren't things that happen overnight. So it's going to take some time. And within that time, not only are they making it more difficult for people to live on a daily basis, but they're creating a whole host of problems that surround, our daily lives. So that's my answer to that.
Okay, I'll take the second question there, and it was something to do with pivot, right? Why is everybody looking for a pivot? Is that the question?
Correct. Yep.
So they're looking for a pivot because they've been wrong all year, and they're hoping the Fed comes in and saves their bacon, right? So they can make their year. So people asking for a pivot don't understand that a pivot would actually probably create bigger problems longer term, right? So, and they're also looking at historicals, right? When the Fed pivots and they start the printing press again, markets go straight up, and that's what they think they're going to see. So that's why they want this, right? I'm down 25, 30%. I'm going to lose half my clients come December. What's her name? The woman that runs the ARC fund, Kathy Wood. I mean, what a disaster. She needs to learn how to run money instead of sending a letter to the freaking Federal Reserve telling them to stop raising rates. It's like, you're an idiot. You lost people 70% of their money, and now you're begging? Screw you, right? So the pivot, and ironically, if we do get a pivot, in 2000 and 2008, when the Fed pivoted, in both those instances, stocks went straight down. I mean, they may go up for a week, 2 weeks, a month and a half, maybe. But then you go back to lower lows, because when they pivot, that means a lot of things are broken, and they're always the last ones to find that out, right? So they're always behind. So if they pivot, that means they've created the mother of all recessions, the mother of all bear markets in most asset classes, and they're panicking. Too late. We got into this mess because of them pivoting. And to think that that's going to fix it is just naive, unless you're Kathy Wood, So.
And I'll add one last thing, is that just because the Fed pivots doesn't change the data. The data is the data, and the data is awful globally. So even if they do pivot, that is not the warm blanket that everybody thinks it is. So just keep that in mind. And they're not going to pivot, but maybe potentially in 23 things change, but it's got to get pretty bad.
Or they'll pivot once, if we walk into a 20% decline in the S&P tomorrow, they'll pivot. But it'll be too late. The damage is done.
Yeah.
Well, perfect. Well, just want to thank everybody. Once again, this is our Forecast Capital Management Q4 2022 market update call. As always, Jason, John, or I, we're always readily available to answer any and all questions you guys might have. So with that, thank you for your time, and I hope you guys have a great rest of your day.
Thanks.
Thanks, guys.